Welcome to the review session for exam 1 for managerial accounting. This is the fall 2022 semester. We're going to be looking at the exam 1 practice exercises. These are not graded. You don't need to submit them. They will allow you to practice with these an unlimited amount of times. And you do not need to submit the assignment, although you can. It doesn't count for your grade. If you are trying to find the set of exercises and you can't find it, you need to change from the link in Cengage that says assignments I can take now, which is the default. You need to either change to all assignments or assignments I can practice now, because this isn't graded. It doesn't show up in those assignments you can take. And our plan for today is to just work our way through these exercises. Hopefully we'll have enough time in the time we have left to get through all of them. As I indicated in the announcement, if you are here live and you can't stay for the whole time, feel free to jump in and out as needed based on your schedule. Just glad you could be here for some of it. And the other comment I would make is, in some semesters I have these kind of review sessions once a week, even when we don't have an exam. And if you would find that beneficial, you just need to let me know. I can be flexible about the time of these. They couldn't be Tuesday or Thursday because of my teaching schedule, but they could be probably Monday, Wednesday, or Friday, and we can switch the time from morning to afternoon. We can switch the time every week. If there's demand for a session like this, I'm happy to do that. If somebody, if people would come, even if one person comes, that's fine with me. So let's take a look at our first exercise. If you haven't noticed, with the exercise numbering, you can tell the chapter that produced this exercise because it says EX. That's telling us it's an exercise from the book. And the next numbers, 15, that's the chapter number. So you can tell that we have a couple from 15, from 16, one from 17, and a couple from 18. So as you're working on the exam, you'll see that same kind of numbering. And if you're wanting to look something up in your book, you just want to refresh your memory or see how that was done, that will give you a starting place because you'll at least know which chapter that question came from. So from chapter 15, we're looking at the income statement for a manufacturing company. And what we're focused on here is really the calculation of the cost of goods sold. For each one of these columns, we are asked to find the missing numbers. So this, like we spent a lot of time in that early chapter, is to focus on the flow of cost through the inventory accounts and what makes this different than a merchandising company. So we're looking at that cost of goods manufactured. We know how that number is calculated. We did a whole statement of the cost of goods manufactured, which is looking at the flows of costs in and out of the work in process account. This is looking at the finished goods inventory and what happened in that account. So for the first column, we started with $49,300 worth of merchandise. Now I should point out on the video, I said this before I started recording, that these exercises are generated algorithmically. So that's what this .algo means. So your exercises may have numbers that are different than my numbers. So the process is the same. The way we do the calculations is the same, but you may, if you're wanting to check your work, if you're doing this on your own in particular, you would need to do the same types of calculations, the same adding and subtracting, but use the numbers in your exercise if they're different. So we start with that beginning inventory, 49.3. We add to it the cost of goods manufactured. So that's the value of the product that we completed this period, in this case, this month, in the month of June, and added to our finished goods inventory. So it's now available for sale. So the first question, letter A there, make this a little bigger. The first question, letter A, is how much did we have available for sale in total throughout the period? And that would be the $315,500, the total of those first two numbers. So that's how much we had available for sale. And at the end of the month, we had only $61,200 left. So what happened to the part that's missing? We must have sold it. It moves off our balance sheet and onto the income statement as cost of goods sold. So B is the difference between A and our ending inventory. Again, as I said, just stop me if you do have questions. I'm happy to answer questions as we go along if you have them. Let's try the second column then. So we're always looking for an equation where we have just one missing piece or one variable. And so as we look at this, we can see that we had $131,100 worth of inventory available for sale at some point during the month. And of that number, 13,800 was already in beginning inventory. So if we subtract the 13,800 from the 131,100, we get 117,300, and that must be how much we finished during the month and added to our goods available for sale. Starting again from the 131,100 that we had available for sale, just like we did in the previous column, if at the end of the month we still had 27,500 left, then we must have sold 103,600. If there aren't any questions, I'd ask you to try the third column on your own. And I will put my answers here on the screen. Give you just a moment to try those on your own. And so in that third column, again, we're looking for a way of piecing these together so that we have just one variable or one missing piece. If we had $75,900 worth of merchandise available for sale and 48,300 of that was made this month, then it must be the difference. 27,600 is how much we had at the beginning of the month already available for sale. And then for the last one, if we had $75,900 worth of goods available for sale and we sold 69,800, how much would we have left? The difference between those is 6,100. So for this first exam and throughout the semester, really, you should be very familiar with the flow of costs in and out of all of those inventory accounts, not just the finished goods inventory, but also the work in process. Any questions? Are we ready to move on?
Yes.
So the next exercise in the practice set, also from chapter 15, is that statement of the cost of goods manufactured. So this is what I've already mentioned. This really is looking at the flow of costs in and out of the work in process account. So we start with our work in process at the beginning of the month, and then we're going to see what went into the account and what came out of the account. So as we look at what's given here, we're preparing this statement for the month ended March 31st. I should point out that this is not a financial statement in the way we think of financial statements from financial accounting. It's not an income statement, balance sheet, stockholders' equity, cash flow statement. This is not publicly available. It does not become part of their annual report. So we do need the information from this, specifically this cost of goods manufactured. We need to prepare our financial statements, to prepare our income statement. But the information that's on here really is confidential or proprietary. The company would not likely share this information. So this is more of a report than a financial statement. But again, we start with the beginning inventory in our work in process. So that is right here, 111,380. And then we say, what did we add to it? Well, we need to analyze the flow of costs in and out of the materials inventory to determine how much we transferred into work in process. So we start with our this section with the beginning balance in our materials inventory, 168,750 in my exercise at least. What did we add to that? So how much more did we buy? And that's right here, materials purchased during March, 324,000. So when we purchase those materials, we add them to the materials inventory account, and that tells us how much materials, how the value of the materials we had available to use during the month, if we add those two pieces together. Okay, so we know we had, I'm just rounding off, about $500,000 worth of materials available to use. And at the end of the month, when we looked at our remaining inventory, we had $145,130 worth of materials left. And so just like we did in the previous exercise, we can subtract that ending balance from the materials we had available to find, if I can copy correctly from my calculator, we can find the amount, the cost of the direct materials that we used. And in using my numbers, that would be $347,620. So we know that in the work in process account, we're adding all three of the product component costs: direct materials, direct labor, and overhead. So we now know the direct materials. We still need to add to that our direct labor and then our overhead. So what do we know about direct labor? It's actually given to us right here. So direct labor is the next input, $303,750. And then we have this list of factory overhead. So for our purposes, we're going to have to list each one of these and add that number. Whoops, let me make that just a tiny bit smaller maybe. Hopefully you can still see that. Guess I can't really make it too much smaller. 19,580. So I'm just pulling in each one of these categories of indirect cost. These are costs that become part of the cost of the product, but we can't trace them easily, conveniently, economically to the specific product or batch of products. So they go into that overhead account and then get allocated. And in chapter 16, we learned how to allocate overhead using the traditional approach, the single factory rate. In the chapter that we just finished this week, we looked at a multiple department rate, and then we were looking at activity-based costing as well in chapter 18. So let me quickly add up that list of numbers. I added correctly, it's $77,640. And so now we know all of the costs that were added during the month. We have our direct materials of $347,620. We have our direct labor of $303,750, and then the overhead that we just added up. So if I add those three together, we know how much was added to work in process during the month. And the next step is to include with that what was already in, what was already in work in process, the beginning balance of $111,380. And we have our total manufacturing costs. So this is the beginning balance plus what we added to it, direct materials, direct labor, and overhead, combined to be $840,390 were in that work in process account at some point during the month. If we then subtract our ending balance, which is right here, our work in process ending balance in my numbers was $95,790. So that's how much we're still working on at the end of the month. If we subtract that, we will get the total that was manufactured and moved into the finished goods inventory. I should probably remind you, I'm just going to jump over here to the Brightspace course. I'm going to remind you that in the reference materials in Brightspace, I do have some, if I can get there. So I do have some basic calculations for a manufacturing firm that's going to remind you of these relationships. So we've got some formulas here. All of these are going to be helpful in exercises like what we're doing here. So in case you're wondering, how does she know that? Where do those numbers come from? This is what we just did here. And this is what we did in the first exercise and what we're about to do at the end here. And I'm just going to copy that over. So there's the formula. Ignore that C above since we don't have that here. But here's the formula that I just copied from Brightspace that is how we're going to calculate the cost of goods sold here at the bottom. So we need our beginning finished goods inventory, which is right here, $86,060. We add to that our cost of goods manufactured, which is what we just calculated, $744,600. So that gives us our total goods available for sale. And then we subtract the ending finished goods inventory. To get our cost of goods sold. So remember that the exam is intended to be open book, open notes. You're going to open your book from the study tools before you open the exam, but you absolutely can be in Brightspace and be navigating around in Brightspace, even though you can't really navigate around in Cengage and See Now once you open the exam. But all of these kind of pages, you can have open in a separate tab, just like I do here, and refer to any of those reference materials in Brightspace. Obviously, you could print them if you find it more helpful, or copy them into a notebook if you find that more helpful than jumping around. But the exams are absolutely intended for you to be using all of your, whoops, okay, I just clicked on the wrong thing there. So it's like a typo. So any questions from that exercise? So let me clear my drawings and we will keep going. Okay, so this is from chapter 16, and one of the most important things we did in chapter 16, in addition to talking about job order costing, was to allocate overhead using what I refer to as the traditional approach, or the single factory overhead, or the single plant-wide method. And so what we're asked to do here is to calculate the predetermined shop overhead rate per direct labor hour. And so the first step is to figure out, of these costs and expenses that are listed here, how many of these are part of our overhead. So I'm just going to kind of check these off. So the ones that would not be part of overhead would be direct labor, because that is a direct cost. If we had direct materials, that would also not be part of overhead. The advertising expense is not part of overhead. That's what we call a period expense. It's part of selling, general, and administrative. Same thing for these administrative salaries and administrative office depreciation. So all of those are, these final three are period costs, and direct labor is a direct cost, so it's not part of the indirect cost. So everything else here, colors, engine parts, that's definitely part of the cost of making the product, but it's hard to trace that to a specific product or batch of products, which is what makes that an overhead cost. Same thing for depreciation on the equipment. The shop supervisor, property tax, and supplies, all of those are examples of items that are costs that we incur to make the product, but it's really hard to trace it to a specific product. So the ones that I just green checked, I'm going to add those up so we can find our total overhead. You'll notice it calls these estimated costs and expenses. So these are our budgeted costs. And I'm just adding up the ones that I green checked there. Glad I didn't use a blue check. So if I added those up correctly, the total overhead we have budgeted, $1,495,300. Now we know that the first step in the allocation process is to set this predetermined overhead rate, but we have to decide what our cost driver is. And in this exercise, we're told that our cost driver is going to be direct labor hours. But you'll notice it doesn't tell us what our direct labor hours are, so we're going to have to figure that out. So the direct labor cost, we are told is $950,000. And we're told further down here that the average shop direct labor is $25 per hour. So if we take that total 950,000 and divide by $25 per hour, that will give us the number of hours that they based the total shop direct labor on. So they're expecting to work 38,000 direct labor hours at $25 an hour. That's where the $950,000 shop direct labor number came from. So to calculate our, for the final step here, to calculate our cost of overhead per direct labor hour, we can now take the total overhead, $1,495,300, and divide by the estimated level of the cost driver. That is, how many direct labor hours do they expect to work? 38,000. We're asked to round our answer to the nearest cent. And so I got $39.35. Again, that's the total overhead here, $1,495,300, divided by the estimated number of direct labor hours, because that's what we determined was our cost driver or our allocation base. Okay, what did I add wrong? Where did I do my math wrong? me 1 second. Okay, so trying to find my error. I just checked and then I realized I didn't actually read this part. Whoops, I did. So I didn't read the exercise well. This tells us that what we do is perform engine repair work. So this engine parts is actually the direct materials. And I was looking at it like that was the part of the equipment that they use, but that's not what it meant. And I just didn't read carefully. Hopefully you all are more careful about your reading than I just was, because these engine parts should not be included in the total overhead. So that's the mistake that I made. So if I just recalculate that, taking out those engine parts, that brings our total overhead down to just a much lower number of 193,800. So big difference from what I had. And now I need to recalculate this based on that much smaller number, 198,300. Sorry, 193,800. Okay, let me just redo that math quickly. Adding up just the Yep, 193,800. Okay. Divide that by the 38,000 hours. $5.10 per hour. So my sincere apologies. I really need to be more careful about reading, because these engine parts are definitely the direct materials piece. And I just wasn't recognizing that. I thought it was part of the equipment that we use to perform the service, but it's not. So now that I've corrected my big mistake, any questions on that? Does that make sense? And maybe you guys were wondering about that. Why did she say engine parts are part of the overhead? It's because I didn't read it. I just really need to be more careful about that. It's not the first time I've done that kind of thing either. That's bad. So let's keep going. We're looking now at exercise 16, the financial statements, or excuse me, chapter 16, financial statements of a manufacturing firm. We have an income statement. And again, remember, you have those formulas in the basic calculations for a manufacturing firm that are going to help here. The income statement for a manufacturing firm looks very similar to the multi-step income statement that we learned way back in chapter 5 in financial accounting. So revenues minus cost of goods sold gives us our gross profit or gross margin. We then subtract from that our selling expenses and our administrative expenses to get our net income or net loss. And I'm putting it as operating income now, but we know when we get there, if it's a negative number, that would be a net loss. So let's start with our revenues. And revenues earned by selling bikes, 1,062,500. And then we need our cost of goods sold. So they've given that to us right here, sold goods with a cost of $593,600. So we already know how to calculate that. We know that the calculations are on that page in Brightspace if we need them. So here we have our gross profit or our gross margin. It's what's left of our revenues after we cover the cost of goods sold. And we have our selling expenses, which are given right here. And then our administrative expenses on the next line down. Add those to get the total selling and administrative. And subtract that from our gross profit to get our, in this case, it will be an operating income. So the difference between operating income and net income, if you are wondering. So net income would include any income tax owed on that. If there were any other non-recurring items, or what we call not items that are below the line, so that would include any discontinued operations, any rare and unusual non-recurring events, that would also not be included in operating income. So operating income is just from the continuing operations and does not include income tax expense. I just wanted to clarify that because I had said net income, but this isn't, there's no income tax shown here, so we know it's not actually the net income. Last step then is to determine the inventory balances. Remember, this is the first month of operations, so we don't have any beginning inventory, and that makes these calculations easier. So for our materials inventory, we didn't have anything at the beginning of the period, but we purchased $298,300 worth of materials, and we used $256,500 of those. So how much do we have left? $41,800. For our work in process then, what we started with is, again, is zero beginning inventory, but we added to that those direct materials, $256,500, plus our direct labor of $220,000, plus overhead. And it tells us that overhead is applied at a rate of 75% of direct labor. So we're going to add to that 75% of 220,000. And so the total that we added to the work in process account, direct materials, direct labor, and the applied overhead, $641,500. But of that amount, we finished and transferred out $615,800, leaving in that account $25,700. Okay, so the main formula would be beginning inventory plus direct materials, direct labor, overhead, minus the cost of goods manufactured gives us the ending inventory. And then our final calculation for finished goods inventory, again, we had a zero beginning balance, but we moved into that account $615,800. That's we had available for sale, and we actually sold $593,600. So our ending finished goods would be the difference, $22,200. So this was made simpler by knowing that this was their first month of operation, so they had no beginning inventories, but you should recognize how those beginning inventories would play into these calculations. Again, using those formulas in Brightspace and using the same approach that we've used in these a couple exercises already today. Ready to move on? So moving on to chapter 17. So chapter 17 was the process costing chapter. Remember, I had shared with you, if we go back to the reference materials, in Brightspace in the Chapter 17 folder. I shared with you this Excel spreadsheet that you may find useful. We used it during class, and so, or on the video if you watch the videos. And so you may find that template helpful to kind of organize this type of information. So they actually have provided to us in this exercise the same format as I have in that Excel spreadsheet. But I think Excel is very helpful because we can actually do the calculations right in the cells, and then you can see what your calculations were. But we're going to go ahead with this exercise. The cutting department of Karachi Carpet Company provides the following data for January. Assume that all materials are added at the beginning of the process, and we've said that's one of the assumptions that we will make for all of the work that we do for this class, even though we know that that's not necessarily the case in the real world, that all direct materials are not always added at the beginning of the process, but we use that simplifying assumption. So we'll start here with step 1. And remember, again, back to the reference materials, I have this cost of production report, Exhibit 8 right here, the image, and that's directly from your book. So that would give you a visual of what it is that you're trying to set up here, if you find that helpful as a reference. So at the beginning of the month of January, we had 13,600 units in process. And we started during January an additional 209,600 units worth of product. So the total units to be accounted for in the cutting department, 223,200. So we are using the FIFO approach, or the FIFO method. The assumption is the first thing we do is finish up those units that are in beginning inventory. Because those units were started in December, we would have added all of the direct materials in December, so we add no new direct materials in January. We're told that those units were 70% complete, and so if they were already 70% complete, we had 30% of the work left to do. So 13,600 times 30%, that's equivalent to 4,080 whole units worth of work. Remember, in this first step that we're doing here, this is all units only. There are no dollars here. These are units only. So we had to do 4,080 equivalent whole units more of conversion work. That includes both our direct labor and overhead costs combined. Now we know that during the month we started 209,600 units, but we didn't finish all of them. We had still an ending inventory, 11,200. So the units we started and finished, the difference between the units we started and the units we did not finish, those are still in ending inventory, 198,400 whole units. So these units were both started and completed in January. So we did all of the work, we added all of the direct materials. Now we're just adding down the 2 rows. And then we move on to our ending inventory. So we're told here that our ending inventory is 11,200 units, and those were 30% complete. So 11,200 units that we need to account for. Well, our rule about adding all of the direct materials at the beginning of the process means that we added 11,200 units of direct materials, but we'd only done 30% of the work. 30% of 11,200 is 3,360. And I'm just adding down. And so now we have all of our units. The next section then is to summarize our costs. So our total cost for January in the cutting department added for direct materials. See, we have a number right here. Whoops, sorry. Number right here for the direct materials that were added during January, $2,211,280. Just want to make sure I got that right. And our total costs incurred for conversion work during January, we know that conversion costs are the total of the direct labor and the overhead. So it's actually both of those rows added together for direct labor and overhead. That's what makes up our conversion costs. And our total equivalent units, we just calculated here in our previous step. And then we just need to divide. So the total cost divided by the total units gives us our cost per unit for the month of January. Good so far?
Where'd you get the 198,400 from? Like up above in the, yeah.
Oh, this right here. It's
Yes.
just the total of the two lines above it. And so this number is, we started 209,600 units during January.
Okay.
And 11,200 of them were not complete. So we're trying to find the number that we started and completed.
Gotcha.
So started minus not completed is the 198.4.
All right, thank you.
Mm-hmm. So our last step is to assign those costs. So our first piece here, inventory in process. So these are going to be all dollars. In this step, everything is in dollars. Remember, in the first steps, everything was in unit. This cost, this step right here is to calculate the cost per unit. So we bring those pieces together. And then our final step is cost only. So no units showing up in this final part. So our beginning inventory had a total cost of $174,760. And then our costs that were added during the month would be the combination of the direct materials and the conversion costs. So if we add those two together, we will find the total amount, total cost that was added during the month for all three pieces: direct material, direct labor, and overhead. Add that to the beginning inventory. And what we know then is that number must be equal to this number down in the final step. And so it gives us a way of checking ourselves. So again, we add our, start with the beginning inventory. Now, as I said, we're using the FIFO method, first in, first out. So the assumption is the first thing we do is finish up that beginning inventory. So if we go back to our first step here, what did we have to do to finish the beginning inventory? Well, we'd already added all the direct materials, but we still had to do some conversion work, direct labor and overhead. Specifically 4,080 units of conversion cost, and the conversion cost per unit this month was $3.60. So 4,080 units times $3.60. And I should probably put a 0 in there just as a placeholder. So we didn't add any more direct materials, but we did have to do some work to finish up those units. Now add across and then add down, and that gives us the total cost of the beginning inventory to complete it. The next step is those units that were started and completed, and we know that's the 198,400 units. We added the direct materials, 198,400 units of direct materials at $10.55 each. And the same 198,400 units at $3.60 for conversion costs. And that would be, if we add those two together, that's the total cost of the units that were started and completed. If we add to that the cost of the beginning inventory, we will have, so I'm adding down here, we will have the total cost of goods manufactured. That's what was transferred out of this cutting department and into finished goods at the during the month of January. And then the last step is those units that were still in ending inventory. So that's 11,200 units. We added 11,200 units of direct materials at $10.55 each, or $118,160. But we hadn't done all the work. We had done only 3,360 equivalent units of work of conversion costs at $3.60 each. Add across. Whoops. Add across, then add down to make sure that our totals match. And they do. The last step then is to evaluate the change in costs for direct materials and conversion costs from the previous month. So I think they actually even have this calculated for us already. The direct materials from the previous month, from December, were $10.40 each. And this month, how much were they? $10.55 each. So they had increased by 15 cents. And for our conversion cost from December, it was $3.50 each. And for January, it was $3.60 each. So that, of course, is an increase of 10 cents. So that's a very comprehensive problem of everything we did in Chapter 17. As I said, especially for the exam, you may want to keep track of that Excel template because you may find that beneficial. Okay, so moving on then to Chapter 18. So this is the activity-based costing chapter that we just completed over the last 2 class days. The management of Nova Industries Incorporated manufactures gasoline and diesel engines through 2 production departments, fabrication and assembly. Management needs accurate product cost information in order to guide product strategy. presently, the company uses a single plant-wide factory overhead rate for allocating factory overhead to the two products. However, management is considering the multiple production department factory overhead rate method. So we have the following information for the budget, and the cost driver is going to be direct labor hours. So we're asked to calculate first the per unit factory overhead under the single plant-wide factory overhead rate. So that's what we already reviewed from chapter 16. We start with the total budgeted amount given in my numbers as 756,000. And we divide that by the total number of hours. Again, in my numbers, that's 8,400 hours. And so that gives me $90 per hour. And then for the gasoline engine, then if it takes 4 hours for the gasoline engine, $90 per hour times 4 hours, that would be $360 in overhead allocated per engine. And for the diesel engine, also 4 hours. So, whoops, that would get 360 hours worth of, excuse me, $360 worth of overhead applied as well. But then, as it says, they're looking to, they're considering using a more targeted approach, because somebody may have looked at this and said, you know, our fabrication department costs $546,000 in overhead, and the assembly department has only 210,000 hours or dollars in overhead. And the diesel engine takes a lot more time in fabrication, where the gasoline engine takes most of its time in assembly, which is cheaper. So maybe we are distorting our costs by allocating or assigning the same rate, $90 per hour, for every direct labor hour, because fabrication is a lot more expensive than assembly. So the diesel engine should be bearing more of that cost. And so they recalculate, and I'm going to use the white space over here on the side to do my calculations. So rather than having the single plant-wide rate, we're going to calculate separately the cost of fabrication. $546,000 divided by 4,200 hours is $130 per hour. Whoops, per hour. Yep. And then assembly, the cost is only $210,000 for the same 4,200 hours. So obviously a much less expensive overhead category. Just $50 per hour. So makes sense so far? So then for the gasoline engine, we're going to apply 1.3 hours for fabrication at $130 per hour, and then 2.7. So again, I can put these calculations on the screen. So for gasoline, it's 1.3 hours at $130 per hour for the fabrication, and then 2.7 hours at the cheaper $50 per hour. God bless you. And then for the diesel engine, which takes more time in fabrication, 2.7 hours at the more expensive $130 per hour, plus 1.3 hours at the cheaper $50 per hour. So if we can just do those calculations. see the numbers are now going to skew toward the diesel engine being more expensive to produce, at least as far as overhead, more expensive to produce, and the gasoline engine is going to get, each gasoline engine is going to get less of the overhead, because even though it takes the same 4 direct labor hours, more time is spent for the diesel engine in the more expensive department. So to finish this up, management should select the one that gives us the best handle on our actual costs. So that would be the multiple department factory overhead rate. Obviously, it's more work to do the multiple department rate. And so if it gave us basically the same answer either way, we just go with a simpler method. But in this case, because it does give us a better understanding of the true cost of producing each engine, so the single plant-wide rate method uses or indicates that both products have the same factory overhead per unit, because each product uses the direct labor hours equally. Wait, let me see. Thus, the blank method avoids each. Okay, I think this question, each product uses the direct labor hours differently, because it's equal in total, but different between the 2 departments. So that sentence is a little misleading. I think it doesn't give us enough information about what it's asking. Thus, the blank rate avoids the cost distortion. So the multiple department rate avoids the cost distortions by accounting for the overhead in each production department separately. So even though the totals are the same, 4 and 4, the split between the 2 departments is different, and the cost in the 2 departments is different. So I had to read between the lines just a little bit there to see what that third sentence was actually saying. Good. Last one then. Let me just clear my drawings here. So we're still looking at chapter 18, and this was the last thing we did for those of for people who were there live or in the face-to-face class. This is what we did yesterday in class, the activity-based costing. So this goes even one step further than the department, the multiple department rates that we did in that previous exercise. And this isn't looking at the departments at all, it's looking at the activities. So this method is not acceptable for financial accounting purposes, but it's very helpful for internal decision making. Caldwell Home Appliances Incorporated is estimating the activity cost associated with producing ovens and refrigerators. The indirect labor can be traced into 4 separate activity pools. We have them here: procurement, scheduling, materials, and product development. They have identified the activity base that's going to make sense for allocating the cost of each one of those activity pools. And then we are told the usage of each one of those activity bases by each one of the products. So our first step is to calculate the activity rate for each activity cost pool. So we'll start with procurement. Procurement costs $12,600. And we're going to allocate that based on the number of purchase orders, and the total number of purchase orders here is 700. So that's $18 per purchase order. So I'm just going to, well, let's finish the per unit ones first so that I can scroll down and then write on the screen. So for scheduling, total cost for scheduling is $90,000. We're going to allocate that based on the number of production orders, and the total production orders is 1,200. So our cost per production order, $75. Cost for materials handling, the total in my numbers is 11,000. We're going to allocate that based on the number of moves, and the number of moves in total is 500. That's $22 per move. And finally, product development, the total cost is $50,000. We're going to allocate that based on the number of engineering changes, and the total number is estimated to be 200. That's $250 per engineering change order. Now I can scroll down a little bit, and I'm going to use the table that they already have here to put in my numbers. So for ovens, they have 400 purchase orders, and the cost per purchase order is $18. So that would be a total of $7,200. And for refrigerators, they have 300 purchase orders at a cost of $18 each, or $5,400. Production orders are $75 each, so 800 production orders for ovens at $75 would be $60,000. And 400 production orders at $75 for the refrigerators would be $30,000. Materials handling, $22 each times 300 moves for ovens, 6,600. Whoops, put an extra zero in there. And 200 moves at $22 would be 4,400 for refrigerators. Finally, the number of engineering change orders, 80 for ovens at 250. So that's by far the most expensive per unit. And 120 engineering changes for refrigerators at $250, 30,000. So now I'm just going to add across. I'll put those over here in the far right. Just going to add up all of the costs associated with this indirect labor for the ovens. Whoops, wrong number. $93,800 for ovens. And $69,800 for refrigerators. And the last step is to calculate the cost per unit. So I have the totals over here on the right-hand edge, and right next to those is the number of units. So for ovens, $93,800, that's for 1,000 ovens. So that's $93.80 per oven. And for refrigerators, $69,800 divided by the 500 refrigerators, or $139,060 per unit. I'm going to stop the recording at this point.